Welcome back! In this second presentation on stocks, we'll discuss securities marketplaces. In other words, where do you buy and sell these things? And then we'll start to dig into the different indices and how we measure how well the stock market's doing as a whole, and then we'll start looking at individual stocks and numerical measures for individual stocks. And we hope to show you that it's really not as hard as people make it out to be. As Warren Buffett says, investing is simple, but it ain't easy. And we've already discussed that, right? The intellectual part is relatively straightforward. What's difficult is the emotional part and predicting the future, because nobody can predict the future accurately. It's easy to predict the future inaccurately, and a lot of people do it, and get paid pretty well, and maybe you can be one of them. Anyway, let's start on slide number 19. What are securities marketplaces? What a silly name. It's just where are these things traded. That's what it means. Securities is just, it's a fancy term that means financial assets that can be traded between investors. And the marketplace, the securities exchange, is where this happens. And for decades, for almost 200 years, over 200 years, the place to be was the New York Stock Exchange, the big board. But you know what? It's now owned by a derivatives trading firm in Atlanta. And what are derivatives? Don't even bother with them. They're just scary ways to lose a lot of money quickly. Yeah, and then the American Exchange, it used to be called the Curb. Why? Because it started out on the curb outside the New York Stock Exchange. Well, they got their own building, thankfully, because it's cold in the wintertime out on the streets. But then they got purchased by the NASDAQ, which then gave them up. And then they got purchased by the New York Stock Exchange, and they changed the name to the New York Stock Exchange MKT. I'm sorry, MKT Market, I guess it's supposed to be MKT. Anyway, but what happened? They were never very big, right? The American Exchange, they were the little kid down the street. But the NASDAQ, the National Association of Securities Dealers Automated Quotation System, which they don't want you to remember, that's what it originally meant for. They just wanted to be called the NASDAQ. They got big, yeah, and that's where the technology stocks like Microsoft and Apple and Intel, that's where they live. And so now it's a two-horse race, the New York Stock Exchange and the NASDAQ. The over-the-counter markets, folks, stay away from these places. If anybody tries to get you to buy a stock, a penny stock, on the bulletin boards or the pink sheets, just stay away. If that's the wrong side of town, the red light district, the wrong side of the tracks, it's just the wrong place to be. And so let's read. For hundreds of years, these marketplaces, and for the New York Stock Exchange and the New York Stock Exchange MKT, American Exchange, they were centralized locations. But that's the old technology. With today's technology, the vast majority of transactions occur electronically. No one's yelling and screaming at one another anymore. There's a little bit of that. There's a few transactions that still occur there, but really, I think they just keep it around for show. I really do. So they have something to show on the television at night. So when you go online and buy and sell stocks, or your broker does it for you, or your mutual fund does it for you, it's all happening electronically now. Yeah. Slide number 20. To gauge the current condition of stocks in general, financial professionals have created various stock market indices. It's just a list of stocks, folks. That's all it is. We call them stock market indexes, indices, averages. And by far the most popular, even though it's not a very good one, is the Dow Jones Industrial Average. The Dow. Yeah, it's the granddaddy of them all, started in 1896. But the problem with it is it's only 30 companies. Now, these are some of the largest and best-known companies, but still, it's only 30 companies. So it has a tendency to not reflect very well the overall market conditions, although people look at it for the market. And what we would do in the face-to-face class now is jump to this handout that I give to say, hey, I'm going to give you $10,000, 80-some years ago, okay? A long time ago. And which company would you pick, okay? So, you can do that on your own. It's in Canvas, and it's also on the website. So do that one on your own, but don't peek, all right? Choose one company and listen to the commentary, and then, how'd you do? The better measure, but the one you don't hear as much of, if you follow the stock market, you're going to hear about it, but the one that they often don't talk about on the news is the Standard & Poor's 500. That traditionally is a list of the 500 largest companies in the United States. Now, a few of them are foreign because some foreign companies have purchased very large United States companies, but they're mostly United States companies. They're big companies. And this one's a better gauge. Although it's not perfect either, because nothing is. And we discussed the imperfections in the Business 123 Introduction to Investments class. The NASDAQ. Remember we talked about the NASDAQ? Well, the NASDAQ Composite Index is a list of stocks that's on the NASDAQ. And most of them are high-tech companies. Not all. Costco is on the NASDAQ, Starbucks. So not all the companies are high-tech companies. But when we want to see how the technology part of the economy is doing, and the companies that make up that technology part, we often point to the NASDAQ. So these are the big three, and you'll often hear, they always talk about the Dow. I don't know why, because it's not that good. But they'll also include the NASDAQ, and sometimes they'll have all three, the Standard & Poor's, the Dow, and the NASDAQ. Now, there are others, though, that are going to become more important to us in the next chapter, because the world is not just the S&P 500. And on slide 21, we see a few of the others that are important, but you don't hear too much about them until you get involved in the industry or you start investing. And the first one, which I hate the name, they used to call it the Wilshire 5000. Now they've called it the Dow. The Dow Jones somehow made a deal with Dow Jones, by the way, they're the folks that published the Wall Street Journal, but they're now owned by Fox News, so figure that one out. Dow Jones U.S. Total Stock Market Index. Huh? Well, it started out as the Wilshire 5000. That's what it was called, but that's not what it's called anymore. And it varies up and down. At one time it was 7,000 stocks. Now it's down to about 4,000. But the idea is we want to get the large companies, that's the S&P 500, and the medium-sized and the small companies. So you'll sometimes hear people call this the entire stock market or the total stock market. Yeah, the big companies, medium-sized, and the large companies. And we'll discuss that later on. What's the Russell 2000? Well, this is meant to represent just the small and the medium-sized companies. Huh? What do? They take the top 3,000 companies by size, and they lop off the top 1,000. So how are companies in the small and medium-sized world doing? And then, all we've been discussing is the United States. What about outside the United States? Well, many years ago, a company called Capital Group, Capital International, the division of Capital. You've never heard of them, but they're very big, and they're actually a very good company. They started investing outside the United States, and they said, you know what? We want to have some kind of measurement for what's going on outside the United States. So they created the World Index. But then they were measuring themselves. Yeah, not a good idea. Definitely a conflict of interest. So they sold it to Morgan Stanley. So that's why MSCI stands for Morgan Stanley Capital International World Index. And that was the entire world, the United States and everybody else. But, many years ago, that was only a few parts of the world. Western Europe, Canada, South Africa, Australia, Japan, who else? Hong Kong, Singapore. And so instead of just changing it so that it would include, South America and Eastern Europe and China and India and the Philippines and Taiwan and Korea, they created a new index called the MSCI All Country World Index. Now, they didn't ask me. I mean, I would have told them, well, just change the world index so it's a world index. So people don't have to remember all country world index. I mean, it's a goofball. But, hey, that's their business, and they don't care about what I think. And the other one, the MSCI EAFE, and that's how it's pronounced, by the way, EAFE, stands for Europe, Australia, and the Far East. So in other words, how are companies doing outside the United States, right? And again, they never changed the EAFE. They just let, they had a Europe, Canada, Australia, South Africa, who else? Japan, Hong Kong, Australia, of course, Singapore. And they never changed it. They just kept it, and they created a new one called the MSCI All Country World ex USA. How's he supposed to remember that? I mean, it's a dumb name, but hey, that's what it is. And so these you don't hear too much about, but they're important because we want to know how the world is doing. The small company stocks, all the stocks in the United States, how's the world doing, including the United States, and the world without the United States. And so I follow them, certainly, and most professionals do. Slide 22. Have you heard the terms bull market, bear market? Well, we won't get into the etymology of how that's the right word, right? Etymology of how these words were created. But bull markets mean everybody's happy. More investors buying stock market increases, the economy's doing well. Bear markets are when the market goes down and more investors are selling stocks, so the stocks decline. And this is normally defined as a 20% or more decline. If it falls 5, 10, 15%, that's just a correction. Whatever, it's going down. And for whatever reason, sometimes it's because people get spooked. They just get there's an old, it's a bit of a joke because there's an old saying that there's three emotions that rule the markets: fear, greed, and greed. It's a joke because greed usually wins out. But sometimes fear wins out, so fear and greed. And sometimes people just get frightened and everybody heads for the exits. Yeah, well, other times it's a real reason. The economies are tanking for whatever reason, and people decide, you know what, I don't want to invest in stocks now. But those bear markets turn out to be the best times to invest, folks, historically, because when do you want to buy? Right, you want to buy high. You want to buy low. You want to sell high, you want to buy low. But again, emotions come into the game. And, of course, if the market goes down and stays down and becomes basically worthless, then it doesn't really matter where your money is, because that means the whole economy has failed and we'll all be digging for beetle grubs and eating bark for dinner, boiling bark for, let's not go there. Slide 23, stock analysis. Okay, where do we start, right? Well, Benjamin Graham was Warren Buffett's teacher, and he wrote in a phenomenal book, The Intelligent Investor. Don't read it as your first book, okay, because it's pretty weighty. There's a few other books, One Up on Wall Street, A Random Walk Down Wall Street. Those are better to start with. But he said it very succinctly: show me the numbers. Just see it. Show me how it's doing. But there are dozens and dozens of numeric measures. And so we're only going to learn a few of them, folks. Some of the most popular over the years have been capitalization, book value, earnings per share, price to earnings ratio, and the dividend yield. So let's take a look at these. And as we go through this in the face-to-face class, we would, of course, be going to the worksheet, because there's a worksheet for Chapter 12, and it turns out that the calculations are a whole lot easier than the bond calculations. So you can follow along in the presentation and do them, pause the presentation, or just, do it afterwards. But do them, okay? Please do them. And what I hope you will find is you'll say, this isn't that hard. And the truth is it isn't. The understanding of the stocks and the measurements and the like, they're really not that hard. What is difficult is simply adding your judgment about which companies to buy, because the world is always changing, and it's very difficult. It's impossible to accurately predict the future, as we've said. If if we knew what was going to happen, we wouldn't call it the future, right? It's easy to look at the past and say, well, gee, I should have sold, I should have bought. But it's harder when you're looking into the fog of the future. Slide 24. Market capitalization. It's a very important number that people just don't even bother looking at. Everyone looks at the stock price. That's the wrong thing to do, folks. It's really not a smart thing to do just to look at the price. You have to look at the value of the company. And how do you get that? That's what the capitalization is. You take the number of shares multiplied times the current price of the stock. See, the current price of the stock is meaningless unless you know how many shares there are. That's what the company is actually worth. If you wanted to buy the company, if you wanted to buy the whole company, that's what you'd need. Actually, you need a little more because as soon as you started buying all the shares, the price would start going up, and that's the problem. But anyway, there are three major groups. The Papa Bears, the Mama Bears, and the Baby Bears. I don't know if that helps you use it. But large cap stocks are generally considered anything over 10 billion. Now you're hearing more and more people, this number changes over time as companies get larger. You're hearing more and more people say, "Nah, it's got to be at least 15 billion before it's a large cap stock." Well, you decide. You pick either one. If it's a 10 billion, 12 billion dollar stock and you say, "Well, it's large cap," I'll accept it. If you say it's mid cap, the medium-sized companies, I'll accept that also. When you get above 100 billion, you get into the rarefied world of what are called mega cap stocks. It's a subset of large cap, so you don't have to remember it. If you do, great. If you don't worry about it. But these are big companies. The brand names that you've all heard of, and certainly the tech titans, as they're often called, like Apple and Microsoft and Facebook and Google and Netflix and Amazon. These are all mega cap stocks. But you don't have to remember that. Just remember large. Anything above 10 billion. Now, in our class, we'll do between 1 and 2 billion to 10 billion for the Mama Bears, the mid-cap stocks. And you've probably heard of some of them, but most of them you will not have heard of. Again, some people will say, no, it's got to be at least 4 or 5 billion, up to 15 billion to be mid-cap. And either one is it's up to you. You decide. I'll take either. And then when you get into the small cap stocks, most of these companies you've never heard of. Some of them you have, but most of them you've never heard of. And they're anywhere from, 100 million or so up to 1 or 2 billion. But again, people are saying, no, it has to be up to 3 or 4 billion before it's leaving small caps. Anything below about 100 million is considered micro cap. It's still a small cap stock. You decide if you want to remember that, but that's a subset, micro cap. And these companies, most of them you've never ever heard of, and you can make a lot of money off of these things, folks, but you can also lose everything because every big company at one time was small, right? Obviously, by definition, you got to start somewhere, but normally, no, folks. Many of them disappear. And you'll hear people say that small cap stocks have done better than large cap stocks over time. And they're right in one respect, and they're wrong in another respect. The problem is they often don't count the ones that just disappear. It's called survivorship bias. And so with survivorship bias, the ones who disappear don't get counted. And so that's why it looks like that small company stocks have done better. But the truth is, if you're a good stock picker and you pick small company stocks well, you're going to do well. But it's going to be very volatile. Now, penny stocks. These are companies we shouldn't even mention. We just shouldn't even mention them in polite company because, folks, this is the way to get poor quickly. Stay away from them. Those are the stocks that are on the bulletin boards and the pink sheets that we talked about. Just stay away. And they say anywhere from $1 to $5, but that's not necessarily true. Some of them are pennies, literally 5 cents or 7 cents. And sure, if it goes up to 12 cents, you're going to make a lot of money, but it's more likely to go down to 1 cent or a whole lot less. And we see some examples on the website and in Canvas. You'll see some examples of just there's thousands of them, folks, and they're almost all scams. Yeah, almost all. Stay away. Slide 25. So here's an example. We have $50 price. Well, how much is the company worth? Well, we don't know until we know how many shares are out there. How many shares are out there and being traded? If you have 2 million shares, that's $50 times 2 million, or $100 million worth of market capitalization. This is a small cap stock. The stock price, for the most part, is irrelevant. You must look at the market cap to see what the value of the company is, and we'll see some examples later. Okay, so if you wanted to own this stock, you'd have to have $100 million in your pocket and go down to the exchange and say, I want to buy this. Well, as we said, it doesn't really work that way. If one company wants to take over another company, or an individual wants to take over another company, they go to the exchange and they say, look, we're interested in buying this company. So we'll make what it's called a tender offer. I don't know why it's called that, but anyway, and so you have to come up. For example, if this stock we're selling for $50, you have to basically come up with 55 or 56 or a little bit more, anywhere from 10 to 20% more. And then what they do is they have a set methodology for announcing this. And then when they announce it, if investors believe it's a real offer, that this entity, this company or the individual person or group of people can actually come through with the goods, the price will snap right to that, or maybe a little bit below that, or maybe a little above that, that number. So you think there's some hanky-panky going on? Right. Somebody could just come along and say, yeah, I'll pay $55 a share. The price jumps to 55, and then it turns out that they were just blowing smoke, and the price falls back to 50. Yeah, there's a lot of shenanigans that go on down on Wall Street, folks. Nothing's perfect, and it reminds me of that famous bank robber who didn't really say what he was told, everyone says he says, but he was supposedly asked, why do you rob banks? I think his name was Willie Sutton, right? Or Willie Horton? I can't remember. Why do you rob banks? And supposedly said, that's where the money is. You know, he didn't really say it. But anyway, it's a cute story, right? Because this is where the money is. Slide 26, book value. Now, this is an interesting one because this should look familiar to many of you folks. This is the net worth of a company determined by deducting all the liabilities from the corporation's assets and then dividing the remainder by the number of outstanding shares of common stock. So in other words, remember our net worth statement? Assets minus liabilities equals net worth. Well, this is the same thing, but for a corporation. You take the assets, you subtract all the liabilities, and you have a number, and then you divide that by the number of shares, and that tells you how much each individual share is. And it's rarely close to the stock price, often 1/5 or 1/6 or less, right? Why? And it makes sense. It makes sense that it would be. Because if you're a company, the fact that you're in business and earning money means that your worth is more than just the assets on the books. That's what we call book value. If think of a pizza shop or a shoe shop. The pizza shop, what are they? They got pots and pans, and they got some nice fixtures and all the furniture and the like, and the oven is the most expensive thing, right? But if they sold all those pieces, the company would not be worth what it's worth, the fact that it's earning money. The fact that it's a going concern, as the IRS uses the term. So this is true of companies, and we're going to see some examples. Now, every once in a while, the stock price is lower than the book value. It's very rare, but it happens. And when this happens, there's a real danger of the company being raided for the assets and put out of business. So you're working for a company that's been around for over 100 years, and things have changed, the technology has changed, and the company really hasn't kept up. And the price keeps getting lower and lower and lower. But this company has lots of assets. Well, once the price goes below the book value, assuming that the book value is a bona fide number, bona fide meaning real, it's not just on the books by the accountants, then these corporate raiders come in. You might have heard of them, corporate raiders, private equity takeover artists, private equity firms. And they will come in, buy 50% plus 1 shares. Which means they run the company now. They can vote anything into being, and they put the company out of business, sell all the assets, pay off all the debts, and then walk away. Now, how would you feel? You've worked there for 22 years, and now you're out of a job because they liquidated the company. You'd be pretty upset, wouldn't you? And you'd go to your politician and say, why are these people allowed to do what they're doing? This is outrageous. Why are they putting profits over people? And the economists and the takeover artists, if they deemed you worthy enough to speak to, which they probably don't because they've already left on their private jets, they would say, no, you don't understand capitalism. That company needed to be plowed under like a field by a farmer. That capital, which is a fancy word for resources, was not being utilized efficiently. It needed to go out of business. Great, now I'm out of a job. And that's why we have unemployment insurance, folks. We don't have unemployment insurance to pay people not to work. No, that's not what it's for. Now, do some people game the system and take advantage of it? Oh, sure, nothing's perfect. It just doesn't, it's in a perfect world, and there ain't no such thing. People would not do that, but some people do. But the idea is we want this to happen. We want that capital, including the people who are working there, to be better utilized toward furthering the success of our economy. I know it sounds like an advertisement. I apologize, but that's the idea. Now, is it perfect? Of course not. Nothing is. But that's the reason we promote that. We want that to happen. Slide 27. Earnings per share and price to earnings ratio. Now, these two are very important because we can use the earnings per share and think of our little stock, our 1 share of stock, as a little economic engine. How much is our 1 share of stock earning for us? Well, the calculation is fairly straightforward, and we're going to do 1 or 2, but you don't really have to. You just look it up on the Infernal Net. But corporations' after-tax earnings divided by the number of shares, and the idea in the world of investing is to look for growing earnings per share. It's a very dynamic system. We want growth, right? Yeah, well, sometimes companies are growing their earnings very quickly and the stock price becomes very volatile. And other companies that are not growing their earnings very quickly, the stock price is far less volatile, but it's not as exciting, right? That's growth is what people want. Then you take those earnings per share and you relate it back to the price. And this sounds funny, PE, price to earnings ratio, physical education. No, price to earnings ratio. And it's often written as P/E or just PE. This is the most watched market statistic, stock market as a whole and then individual stocks. You take the price of a share of stock and you divide it by the earnings. Usually over the last 12 months, but sometimes they do future earnings. Well, you don't know what the future is going to be, so they estimate it. And a low price to earnings ratio usually means the stock is a less risky investment, whereas a higher price to earnings ratio means that the stock is going to be a higher risk. Now, is it worth it? Yeah, that's the problem, and we'll see. We'll see in 3 to 5 years if it turns out that it was a good idea to go with the low-risky stock or the high-risky stock. And why would we want to own a business? Well, because businesses are in business to earn money. So let's take a look at this example. Here's a company that's earned $2,500,000. Now, is that a lot of money? Yeah, to you and me it is. But we don't know what it means for this corporation until we know how many shares are outstanding. So you take the $2.5 million and divide it by the 5 million shares, and you get 50 cents earnings per share, EPS, which means that every single one of your shares, whether you own 10 or 1,000 or 10,000, everyone is earning 50 cents, like a little engine. Does that make sense? Yeah. No pun intended, folks. And so EPS is 50 cents a share. Now, let's take this 50 cents per share that we just calculated on slide 29 and relate it back to the price. The price of the stock, let's say is $10, example. So you take $10 divided by the 50 cents and you get a PE of 20. Now don't put a percent sign, don't put a dollar sign, it is unitless. There's no unit to it, but some people will throw a percent sign in. It doesn't belong. Is that high? Is that low? Well, let's take a look at slide 30. Historically, a high PE ratio, a PE ratio of 20 or above was considered high and reserved only for the fastest growing stocks. You see, the faster the stock is growing, the higher PE you'll see with the stock associated. Why? Because people are bidding up the price relative to the earnings because they're expecting the earnings to grow. And historically, 5 to 15 was considered average. But at different times of our history, and now, for example, PEs of 30, 40, 50 were not uncommon. And I'll never forget looking down in the height of the internet bubble in the late 90s at the computer and seeing PE for eBay at 10,000. And I said to myself, this ain't going to continue. No way, right? And when the market falls, right, PE ratios fall dramatically. When the market rises, PE ratios rise. The price-to-earnings ratio essentially tells you what the market believes the prospects for a company are. It doesn't mean they're right. Often they are, not all the time. So a high PE company, investors believe that the future for this company is quite bright. A low PE company, very, very pessimistic about the future for that company. And it also gives you an idea of how long in years it will take the company to earn back its price. Not that that's important, but it's something to think about. If you have a PE of 20, that means in 20 years, assuming nothing changes, and of course it's changing all the time, it'll take them 20 years to earn back their price. PE of 6, takes 6 years, a PE of 10,000. Right, that's how you know that was way too high. And of course, eBay went on to lose 80-90% of its value. It didn't disappear. It's still around, unlike many of the other internet companies that are long gone and in the dustbin of history. Now, slide 31, the dividend yield. Oh, boy, do we love dividends, folks. We talked about dividends, right? Dividends are cash in your pocket, folks. They put money in your pocket. Well, they don't send you a check anymore. It's all electronic. But still, it's very cool. Dividends. Companies can pay dividends. They don't have to. They're optional. But they are distributions of the earnings. And the dividend yield is the yearly dollar amount generated by a stock divided by the current market price. In other words, this allows us to compare the stock to a savings account or a bond. And historically, they were in the 4, 5, 6% range for well-established companies. But now 2 to 3% is typical. Many pay nothing because why? They need the money to grow the company. So companies that are growing very rapidly would not pay any dividends. But other companies that have been around for decades, yeah, sure, they're paying great dividends. And some are paying more than 3, 4, 5. We'll take a look. We'll see some examples. Dividends don't lie, dear students. Dividends are cool. Slide 32. Here's an example. If we have $1.50 in dividends coming from this stock, great. How much did we have to pay for those dividends? Well, $87.50. So you take $1.50 divided by $87.50, and it turns out that stock is paying 1.71%. Which is more than what some banks are paying, right? But what's the difference? The bank account is guaranteed by the full faith and credit by the United States government, right? So you're not going to lose money. But what could happen to the price of the stock? It could go to zero. It happens every once in a while with companies, Kodak, GM, when they went bankrupt. But it doesn't often happen. But the price will be volatile, folks. And so next year, the price might be $40 or it might be $120. That's stock investing. But right now, it's paying us 1.7%, which is not bad. Slide 33. Okay, folks. Okay, so now we would have gone over the calculations in the stock, Chapter 12 stock worksheet in the face-to-face class. You could do that now, or you could stop the presentation and do it now, or you can do it later. But let's take a look at some real-world examples. Slide 33, Walmart versus Costco. By looking at you've heard of these two mom-and-pop shops where they sell lots of stuff, yeah. Looking at the price, $86, 188, almost 189. Is Costco bigger than Walmart? No, you know intuitively that no, Walmart's bigger. So let's figure out what's going on here. The earnings per share are $3.28 for Walmart and $6.71 for Costco. So if we do the price to earnings ratio, I just looked them up on the internet, you find that Walmart is 26.2 and Costco is 28.2. Are those high? Well, by today's standards, they're still pretty high, but no, there's a lot of other companies that have higher PEs. And this is why I'm of the opinion that we're heading for a fall, folks. I don't know when it's going to happen. I do know that it's going to happen. I don't know what's going to trigger it. I do know that it will be triggered. And so you just got to be psychologically ready for that. So investors are both saying, for both companies, that we believe the future is bright for Walmart and Costco. Do you agree? Because sometimes the investors are wrong. Sometimes the market is wrong. But truthfully, folks, most often the market is right more often than it's wrong. But right now I think it's wrong. I think we're heading for a fall. But we'll find out, You come back in 3-5 years, see if I was right. The book value. Whoa. The book value for both of them is pretty darn close, isn't it? But it's nowhere near as close as the price. Why? Because investors believe that Walmart and Costco are worth far more than what's the assets on the books after you take away all the liabilities. So nobody's going to put Walmart or Costco out of business. Now the dividends, $2.08 from Walmart and only $2 from Costco. So you take the dividends divided by the price, and the dividend yield for Walmart is 2.4, which is respectable. It's not real high, but it's not low. Look at the dividends for Costco, 1.1%. So what are investors saying? They're saying, we want a higher dividend from Walmart. We'll accept a lower dividend from Costco because we think Costco is going to grow a little faster. And notice the PE is a little higher, so I don't think it's a big deal. But I sure do like those dividends from Walmart. But Costco's a good company, too. But now, what do we find here? The last statistic, the market capitalization. Now, I think there's about 6 billion or so shares of Walmart, and there's only about 2 billion shares. I forget how many shares of Costco. But still, you don't have to do the calculation. You just look it up. $254 billion. Whoa. Walmart is a mega cap company. Costco is no slouch at almost $83 billion. It's still a large cap company. It's still a Papa Bear, but it's about 1/3 the size, as a little less than 1/3 the size of Costco. Now, are investors excited about Walmart and Costco? Yeah, pretty much. They're willing to bid up the price relative to the earnings to 26 for Walmart and 28 for Costco. So, investors are saying that both companies have a decent future. And I agree, although I think the prices are a little too high for me. But then I'm a cheapskate, right? I want to get a company cheap. 34. McDonald's versus Yum. Who are Yum? You know who they are. Kentucky Fried Rat, Taco Smell, and Pizza Crap. I'm sorry. Kentucky Fried Chicken, Taco Bell, and Pizza Crap. Yeah. Anyway, yeah, I don't like fast food joints, folks. The smell. Some people like that smell, but it makes me ill when I ride by on my bike. I just go, ugh. You look at the price of McDonald's and Yum and you say, wow, McDonald's is twice. No, it's actually a lot more than twice the size because we have to look at the market capitalization. But the Earnings per share are $6.37 for McDonald's and $3.70 for Yum. So the PE for McDonald's is 25.4, 22.7 for Yum. So investors are a little bit more excited about the prospects for McDonald's than they are for Kentucky Fried Chicken, but not that much more, not that much more. But wow, look at the book value. They owe more than they own. And do they care? No, they don't care. They can make their debt payments, and neither do investors. In other words, if you wanted to liquidate McDonald's, you'd wind up owing a lot more than the assets on the books. And then Yum, you'd wind up owing 5 times more. Yeah. So both of these companies are believed by investors to be staying in business and not going out of business anytime soon. Now, the dividends per share are $4.04 for McDonald's and $1.44 for Yum. So that gives us a dividend yield of 2.5% for McDonald's and 1.7% for Yum. So, again, 2.5%, that's not bad, really, folks. For dividends, that's actually pretty good. Dividend yield of 2.5%. 1.7% is not that high, but it's better than a lot of savings accounts are paying. And then the market cap. Oh yeah, McDonald's is a mega cap company, $128 billion as of April 13th, 2018. And Yum is a big company, but nowhere near as big as McDonald's. Now, what happened to Yum a few years ago? They were kicking McDonald's butts all over the place in China because it turned out the Chinese like chicken more than they like beef. And they were doing so well, and investors were really excited about the prospects for Yum. And then the bird flu hit in China, and people just stopped going to Kentucky Fried Chicken, even though there's never been a documented case of any human catching the bird flu from a dead cooked chicken. The bird has to be alive for you to get the bird flu. But that didn't stop people from not going to Kentucky Fried Chicken. And so Yum just got hammered. I mean, it was totally out of their control. Nothing they did. And then they decided, what are we going to do? And they broke apart the Chinese part of the company. They spun that off. So now they're going through their things. But do you think either of these companies are going to do well in the future? Well, folks, there's a whole lot of money to be made selling people sugar, salt, and fat. Yeah, they're selling you garbage, folks, is really what they're doing. And they're making a lot of money off it. But, people like sugar, salt, and fat. It's really good for your veins. Anyway, slide number 35. Oh, AT&T and Verizon, the duopoly. Because they are much bigger than Sprint and T-Mobile, folks. And, of course, AT&T. I'm not sure about Verizon, but AT&T is really making a push into Mexico. I don't know if you've ever been down there. You see AT&T ads everywhere. So let's see how they do. We look at the prices and we say $35 for AT&T, $47.50 for Verizon. Is Verizon bigger than AT&T? Well, wait a minute. We got to look at the market capitalization. $4.76 for earnings per share for AT&T. $7.36. The PEs are 7 and 6. Are investors excited about the prospects for AT&T and Verizon? Obviously not. They're not that excited at all. The book values are a lot higher relative to the price than the other companies, but still much below. No one's going to break apart AT&T or liquidate Verizon. And $2 a share for AT&T, $2.36 for Verizon. Look at those dividend yields. 5.7%, 4.9%. Oh my goodness, that's more than what they are paying in bonds, folks. Bonds are not paying anywhere near that. I don't understand. To me, these look like pretty darn good deals. If you're interested in dividends. Obviously, investors are saying, we don't think the growth prospects. Everybody's already got their cell phones, right? Now they're just eating each other's lunch. Some are taking people away from one company, and the other one takes a person away from another company. But I'd be happy with those dividend yields, wouldn't you? 5%, 5.7%. and look at the market capitalization. See, investors are saying, look, these guys are already so big. They're both mega cap companies. And forget the price, right? AT&T is actually a little bigger. Not much, 228 versus 197. But they're both mega cap companies. Now, the question is, do you ever think people will give up their mobile phones? And the answer, I think, is forget it. It's not going to happen. Now, what they're frightened, I think, is people like T-Mobile coming in and saying, we'll give you unlimited, whatever this, unlimited that. And, it's still, people always pay for their cell phones, I think. And, it's up to you. You decide. With a PE that low, there's not a whole lot that can go wrong. But investors are saying there's not a whole lot that's going to go right. Collect your dividend and be happy with it. And I'll tell you, I'm happy with that kind of dividend. That's a pretty darn good dividend. Okay, so now, what I hope you've seen, go back over, do the worksheet, look at these examples, is that it's really not that hard to analyze a company and see what's going on. And what's the hard part? Right, predicting what's going to happen in the future. And remembering that these companies, many of them are multinational. So you have to be able to investigate what's going on all around the world. Right, and that's, something that somebody sitting in a room looking at a computer screen just can't do. And that's why mutual fund companies, which we'll deal with in the next chapter, they have analysts all around the world speaking all different languages and doing their research. Yeah. So we're sort of, even though it's easy for us to take a look at the most readily available information, we're at a big disadvantage to the folks who can mobilize these global investment organizations. But that doesn't mean we can't do well, especially if we stick with large companies that have their roots deep in the economy and have good products and services that people want to buy and use. Yeah. Okay, so again, I apologize. It sounds like an advertisement for BUS121, Introduction to Investments. In our next presentation, we'll discuss some investment strategies and then take a look at some sources of information and continue our investigation into exciting stocks, sexy stocks, risky stocks.